this objective, we are going to be preparing closing entries. So you can kind of take a look at our big T, our capital, and then our smaller t accounts, which I have said before, the capital is the permanent account, and then we have what's called temporary accounts. Well, it's time to do something with those temporary accounts. We use them for the accounting period. Usually it's a year-long, January to December would be a calendar year. And at the end of the accounting period, December 31st, let's say, if the accounting period ended on December 31st, we need to get our books ready for the new year so that we can compare 2017 with 2016 with 2018 year data. It's kind of hard to do that if we don't close out our revenue, our expense, and our drawing account and figure out how did we do in 2017 versus 2016 and get ready for the 2018 year. You can also think of closing entries as if you play basketball and you're done with the game, you won or you lost, how many points. We actually start fresh the new game. You start with a score of 0-0. You can also think of this as your classes. At the end of the semester, some of you are going to be done with that class. You start fresh the next semester. So that's what we're going to do here. We have to what we call zero out or close out our temporary accounts. You don't close out your cash and bank. You don't close out your liabilities, even though that would be great. You only close out your temporary accounts. And for the most part, it's your revenue, your expense, your drawing, and then we'll get into something called your income summary account. So, you might want to take down some notes, but the closing process zeroes out all of your revenue and expense accounts so that we can figure out how we did with, depending on what year we are, how did we do looking at your net income? What was your net income last year? What was it the year before? So we have to close those accounts out. We close out our temporary accounts. We do not close out our permanent accounts, okay? Many of us like to close the capital. You don't do that. Don't close the capital. We close accounts into the capital, but we do not close the capital, okay? Keep that in mind. So what we're going to do is it's a 4-step process. In order for this to work, we're going to use what's called the income summary account. And the income summary has no normal balance. There's no plus, there's no minus. You can actually think of income summary as this part of the income this is income summary right here. You will close your revenue into income summary. You will close your expenses into income summary, and then you'll actually close out your net income or your net loss. So this is a mini income summary account. Okay, so it has no normal balances. You close the revenue onto the credit side of income summary, you close your expenses on the debit side, and then you can kind of figure out if you have net income or net loss. So we'll get more into that in just a bit. All right, so write these down. Step 1 is to close your revenue accounts into income summary. So revenues have a credit balance, so to close it, to get rid of it, whatever the total is for the credit, you would debit the revenue. If you debit the revenue, then you credit income summary. Okay? So the first, and write it down, first step is close your revenue into income summary. The second step is to close your expenses, and you know your expenses have a normal debit balance, So to zero out your expenses, you would credit them. If you credit your expense, you would debit income summary. The next step, third step, is to close your income summary into the capital. So if it has a net income, okay, your revenues are more than your expenses, then you would debit income summary and credit the capital. Now, if it was a net loss, then you would credit income summary and debit the capital. And then the fourth step is to close your drawing account or your withdrawals. And it has a normal debit balance, so to get rid of it, you would credit the drawing account and debit your capital, because the owner's the drawing account decreases the capital, which decreases the capital. Okay. So the first thing you have to do is, like I said, close the revenue account so that they have a zero balance, and you will close the revenues by using the income summary account. So if our service revenue had a balance of $17,500, you would debit service revenue and credit income summary, just like this. The next step is to close all of your expenses. Okay, so let's just say we had rent expense. If it has a debit balance, to get rid of it, you would credit the expense account and then debit your income summary. But usually you have many expense accounts to get rid of, to zero out. So you would credit your rent expense, credit your salaries expense, credit, and you'd only make one entry. So you would credit all of your expenses, add them up, and debit income summary for the total of all of your expense accounts. And then, like I said, this is what your income summary account would look like. You closed your revenue into income summary, you closed your expenses into income summary, and now we have to figure out what is our ending balance in income summary. It looks like we have net income because our revenue was more than our expenses. So we have a balance of $85.50 in income summary credit. So to get rid of it, we have to debit income summary and then credit the capital. Okay, so this is what, I don't know what happened to that picture, but like I said, you would debit income summary, credit the capital. And then the last thing that you want to do, the fourth step, is to close the drawing account. Zero it out, get it ready for the new year. If there was a $5,000 debit in the drawing account, you would credit the drawing account and then debit the capital, because the debit would reduce the capital because the owner took that money out. All right, and that's what your journal entry would look like. All right, we kind of already talked about this. If there was a net loss, then you would debit the capital and credit income summary, and that's for step 3 if there was a net loss. All right, and then this is what your journal entries would look like. Remember, I said there were 3 of them. Close your revenue, close your expenses, close income summary. Now this one, because we're crediting the capital, we had a net income. If this was reversed, then we would have had a net loss. And then you close the drawing account.